You're listening to The Dealmaker's Edge with A.Y. Strauss, diving deep into stories behind commercial real estate leaders. Hello, everybody, and welcome to The Dealmaker's Edge. Today, we are excited to be joined by David Lubin, who's the managing partner and founder of the Clairmont Group, based in New York. The Clairmont Group is a fully integrated real estate investment and management firm that invests in mixed-use, multifamily, hospitality, retail, office, and industrial assets. David oversees the firm's strategic direction as well as acquisitions, development, and asset management. And to date, David has closed over 50 deals valued in excess of $2 billion. His experience includes investments in core, value-add, opportunistic, distressed real estate, which we'll definitely get into, note purchases, fund investments, and co-investments across all major asset classes. David, I really, really appreciate you joining us, and welcome to the Dealmaker's Edge today.
Thank you so much. I'm very excited to be here.
So we've talked a fair amount, and it seems like your background is really just sort of perfect for where we find ourselves today. But before we even get to present, it's always good to roll back the tape and learn about your background more. Usually we start from around college and such, but feel free to go as far back as you'd like. And it's really just to give a flavor to the listeners how you got to where you are present day.
Sure. So I graduated Cornell. After Cornell, my first job was in consulting. And I did corporate strategy and M&A. And the big thing that the consulting firm did was shareholder value analysis, trying to unlock value for various, usually Fortune 500 companies. Then I worked in real estate investment banking, doing M&A and IPO and private placements. And then I went to work for MetLife in the real estate equity group. I worked under Kevin Thorworth, who's the head of the equity group, and he worked under Robert Merck, who was the head of the whole MetLife real estate platform. And I joined right after MetLife sold Peter Cooper Stuytown, so they had a lot of capital that they needed to deploy. And we were deploying capital using joint ventures with some of the best operators in the country at that time. And then the market crash happened, and I ended up going to Columbia. And I joined their real estate development program because I think at that time I felt that I had a pretty good background in terms of strategy, in terms of finance, but what I was actually lacking was the bricks and mortar of real estate. And that's why I wanted to study real estate development. After Columbia, I worked for a real estate distress fund. We were buying a ton of distressed real estate, which I think was kind of perfect timing. And I left that fund in 2014, and I guess almost in 2015. A couple of months later, I started Clairmont Group, and I guess we're going to be around for almost a decade.
Amazing. Congratulations. A lot of deals could be done in a decade, and I know you've had a lot of success to date, and maybe you could talk about those kind of early years. How do you sort of have the courage to strike out on your own? You were obviously, at major institutions, you had all this capital behind you. Maybe people listening to this are considering doing the same thing, and it's kind of a scary leap of faith. So maybe you could talk about what prompted you and maybe some of those, early years and opportunities.
Sure. That's a very good question. So I think, internally, I always knew that I wanted to be an entrepreneur. I kind of felt genetically that I needed to have my own company and to grow something, I guess, similar to what you're doing as well. So for me, it was a matter of time. And when I started Clairmont, it was literally from the ground up. One of the first deals that I did was a 23-unit apartment building in Plainfield, New Jersey, right? Where pretty much I was the asset manager, the manager. We raised capital using crowdfunding platform. And that was kind of at this, and today, we're still obviously growing the company, but, I'm proud to say that we have various lines of businesses. We have an asset management business. We have a property management business that we have grown. We just started a capital markets business. And we also have a fund management business. So after almost a decade, I'm kind of proud to say that we have a vertically and horizontally integrated, and hopefully, it feels like came a long way from buying a single asset and playing field.
Absolutely. And how about raising capital in the early days? Maybe you could talk about the transition from raising from a small building to, I know you've done a lot of shopping center deals and a lot of bigger deals and a lot of intricate, complex deals as well. Maybe raising capital in the early stages, and all the way through to today, and maybe how you graduated from that first small deal, to larger ones.
Sure. So it's really interesting because obviously, when I started, I think crowdfunding was starting at the same time, and we grew with them together. The first deal, it was a couple of million. Then we did a deal that was about 25 million. I think we were the biggest capital raise, and they set up a REIT at that point. But it's interesting because initially we were doing multifamily when the multifamily market was hot. And then it got to the point where we felt the multifamily market was a little bit too hot. We couldn't justify buying apartments at incredibly low cap rates. And my interest and my background has always been an investor, right? I was trained at MetLife as an investor. I worked for a distressed fund as an investor. So my passion's always investing, and I thought, where's the opportunity? And Columbia is also a great school because that's where you're taught value investing. We're trying to figure out where's the value. And we ended up pivoting from multifamily to retail because we thought it was just a great opportunity. We were buying cash flow. We're buying assets that are very good basis. And a big part of what we do is we do a lot of analysis, right? We do a lot of quantitative analysis. And when we looked at the retail industry, we saw that vacancy was all-time low. It was pretty much the same thing as multifamily. And this is just kind of nationally, right?
Sure.
Obviously, sub-markets vary. And unlike office, and multifamily industrial, there wasn't a lot of product coming online. And one of the reasons was because tenants weren't paying such high rents where you could actually build. And we felt kind of, given what's happening with the vacancy, the fact that there's no new product coming online, the fact that we could buy cash flow relatively cheaply, and that's a big part of value investing, and that there's no new product coming online, we felt it was a good thesis. Now, the big question was absorption. And if you take a look at public retail tenants, they kind of have to grow, right? They have to be able to raise money and grow their stock price, they have to expand. So we knew that there's always going to be expansions, and some retailers would go bankrupt while new ones will form. And then our thought was, even if in submarkets you can get the retailers that you want, you can get the nationals, if we're buying assets at a low enough basis, we could always go to the office tenants, the doctors, the lawyers, the dentists, and we could try to get them into retail center because cheaper rents and better parking right in front of them. And also on top of that, you have great signage, right? And great exposure to kind of major traffic. And but it was very difficult to raise retail because if you tell somebody you're buying retail, it's almost like a 4-letter word, right? And And a lot of it, we just did it with our own capital, with partners' capital, and we accumulated a decent portfolio. And now we're seeing a lot of opportunity in helping solve what's happening in the capital markets. And we're seeing a lot of opportunity in distress. And from our perspective, we're not a big fund, right? We don't have to buy billions of dollars of real estate. We just need to identify a couple of great deals to add to our portfolio.
That's a great overview. Maybe we could talk a little bit about sort of where we are now. I know we're jumping a lot of years, and we can sort of do some time travel back and forth and as we go forward in the conversation. But it seems like you're sort of built for this environment today. You had that distress investing background, the value add investing background. And I know now we've talked a fair amount about the fact that these banks have a lot of loans on their books that just need to get resolved in some way or another, whether it's a small technical default, whether it's a total wipeout of equity, whether it's something in between. But distress means something different to every capital stack, every property, every market. What are you seeing on a macro level? And then I know you're also keenly focused on helping solve for that moving target in which we find ourselves in between the lenders and the borrowers and that sort of equity evaporation.
So that's a very good question. I think right now what we're seeing is that there's definitely a decrease in value, and before that, the banks used to try to work things out with the borrowers, right? First it started with COVID, and then as soon as COVID was over, they got hit with interest rate increases. But we're now beginning to see banks actually beginning to sell off notes. And the people, and if they're selling off notes, they're selling off at pretty steep discounts. If they're being obviously forced to sell off. And what we're trying to do is we're trying to figure out a solution where they don't have to take those steep discounts. And I think what we kind of specialize in is being able to approach things creatively, being able to try to figure out how we could add value as a company, where we could potentially maximize real estate value for the banks. And I think a lot of banks right now don't want to foreclose, obviously, because they don't want to take over the assets. But that's also creating a lot of zombie assets where there's no capital that's going in, and the assets are deteriorating. I think the hope would be that interest rates would go back down. The question is, how much are they going to go down? And the market, it's been frozen for a while. We are seeing some banks, like I said, beginning to sell off notes, but it's mostly been frozen. And I think what we're trying to do is we're trying to say, look, there's a solution. We're happy to work with you to come up with a solution where we could maximize value, right? Or if there's a problem, we could potentially retain the value for the asset because we have obviously capital and we have management expertise, and we could put all these different hats on within our company to try to help them figure out the problem.
Well said. And I fully agree. There's a lot of work to do that requires creative financial engineering to help solve. So let's talk maybe about the market sort of bid ask. It seems as if, the market's really been frozen. Obviously, certain asset classes like industrial been trading hot and heavy for the past number of years, almost nonstop. Multifamily seems to have calmed down from its heyday tremendously, given the rates, insurance issues, etc. We're not even going to touch on office because it's just too complex for the moment. But if you're pursuing a deal today, whether it's a standard retail deal you've seen on the equity side, not working with lenders, are you finding that the bid ask is getting closer, or there's still this sort of herd mentality, sellers aren't selling, buyers can't get to their numbers? Or are you seeing that in real time start to shave a little closer on your deals you're trying to do?
we're definitely beginning to see cap rate expansion. I think if you're a seller and you don't have to sell, you're obviously not selling in today's market. But if you're pressured to sell, you're just going to have to come to market, right? And the market is driven by the cost of debt, as we all know. And it's also difficult to invest in assets at low cap rates where you could buy treasuries today at 4 or 5%. So I think assets that we're seeing trade are the ones that are accretive to today's capital markets.
Absolutely. Anything you're particularly bullish about? Any markets, asset classes? Or I know you've been pretty agnostic almost about asset class and deal. You hunt for value wherever you find it. But is there some particular market or asset class, or I know the strategy with the banks you're very focused on and you're going to help solve a lot of problems. But besides for that angle, is there something else you're sort of locked in and excited about these days versus even 3 to 6 months ago? Or it's sort of more status quo?
We still like multifamily. We still really like retail. We think industrial is a little bit hot right now, even with e-commerce. And then office, it's very difficult to solve because of negative absorption that's happening. I think eventually, as the pricing gets to a certain point, it might make sense. So we're not discounting office as an asset class. And in terms of the geographic regions, we're agnostic, right? Our goal is just to find good opportunities that other investors miss, right? And to be able to find unique opportunities, you need to be open and you need to look at a lot of things. But in terms of markets, we cover from Boston all the way to Florida. We want to make sure that we're within 3 hours at least flight of the market. And it's the markets where we have done deals before. So we understand kind of the market dynamics, who the players are, and also have this kind of gut feeling and understanding of what's happening within the market.
Well said. Maybe you could touch on for a minute the idea of transitioning from sort of an individual investor, sort of where you started, to an organization. I would think we've talked a lot about the fact that business is just, there's certainly bricks involved and you're looking at deals and adding value, but it's also the people side. It's hard to scale an organization to, be a wonderful infrastructure to be able to scale the operation. So I'm sure there are always some folks listening to this who maybe bought a deal or two, or maybe 3 or 4, and they may know how to underwrite a transaction. They may know how to find value and raise capital, all hypercritical, without which you can't be successful. But maybe we could talk about the human side a little bit, which we've touched on in the past. How did you make the jump to setting up property management properly, setting up a core asset management operation? The fund business may be more specific, but in general, making that leap to managing an organization from just buying properties. Maybe you could touch on that, because I think that's something that it's hard to teach, and maybe someone will learn from that.
So that's a very good question. I think about this all the time. How do you scale the organization? And we spoke about it before countless times. It's also very important to what I do as an investor, right? And it's something that gives us a big edge. Initially, I was, the joke was 2 guys in a cell phone. I was kind of one guy in a cell phone when I started the company. And there was a period where we were using also institutional property management platform, Pinnacle, which got acquired by Cushman & Wakefield, to manage some of the assets. But in reality, to actually get the edge, you need to have your own platform and your own capabilities. And the process was, we did acquisitions and asset management because coming out of private equity, we knew how to do acquisitions, how to buy stuff, and how to try to execute on the business plan as part of the asset management. And a big part of it was also kind of doing development, because as you buy assets, you need to start developing and fixing things. So the development aspect also came naturally, and brought somebody who's absolutely fantastic on the development front to oversee our development business. And we ended up acquiring a property management company, and that's also a big part of what I was about to say about our edge, is just having data, right? So when you're underwriting the asset, if you have a property management business, you have all the metrics, right, in terms of the operations, right? So kind of what your expenses are down cold. We just started a capital market business, and that allows us to kind of better underwrite debt, right? What's happening in capital markets, and maybe find a little bit that bank that's a little bit cheaper, right? And all those little things end up adding up, right? And when you take the operations side, when you take the capital market side, when you take the development side, those little advantages add up, and they create a platform, right? And they make my job as an investor so much easier, because it gives me data points, and the more data points I have, the more accurate I am in making my decisions.
Well said. I couldn't agree more. And it's fun to watch you make those decisions over and over again with great clarity. And I guess more data leads to more clarity, and also finding the right people that you can mesh with and who have a similar vision for the growth of your organization. So congrats on that, on building the team around you. You mentioned your edge, and we talked about data, but there is a little twist to this podcast, in that we always try to talk about people's headspace too, because they're the bricks, they're the team, they're the investors, there's all of that. But a lot of business is just having the mental wherewithal to sustain the tremendous pressure in which you find yourself in good markets and bad, on good days and bad. And I always am inspired to learn from people like yourself and others similarly situated. How do you position your mindset to do the things that you do? People take for granted that, oh, David just gets this done every day, but there's a lot of pressure to perform constantly. So how do you talk to yourself in your mind on those bad days, on the medium days, on the good days? What kind of drives you day to day as you, continue to focus on execution of your vision?
I think kind of most entrepreneurs will tell you have to like pain to a certain degree. But I think it's the way of dealing with stress. It's what the doctors tell you. It's pretty easy. Get enough sleep. Sleep is very important for me. And there's a lot of great sleep tracking gadgets these days that you could buy, and kind of make sure that you're maximizing your sleep, which decreases your stress levels. And actually being able to get out to the gym. I got 3 kids, so it's no easy task, but I try to make an effort, and it gives me a lot of clarity, and also gives me much better sleep. So I think from just the basic levels, just being able to do that.
100%. And I think you talk to some extremely successful people. I think there's a consistent viewpoint that it's always a work in progress. Some people say that they don't have these issues, but the most successful, and to people who are trying to grow, there's always going to be challenges. So it's always nice when people open up about going through those challenges. Anything else that you think we should have touched on that we didn't touch on more, you'd love to address, or maybe elucidate another theme that we haven't really touched on in the conversation?
That's a good question. I think right now we're kind of in a unique portion of the cycle. And I know to a lot of friends in the industry, it's been slow, right? If you're on a legal side, there's not a lot of transactions. There's not a lot of transaction business. If you're either investment sales, there's also not a lot of transactions. If you're an acquisition, there's not a lot of transactions. So, but I think it's slow, but there's opportunities in other things, right? There's issues. And there's a big issues with decrease in values and what banks have on their books. And those issues create opportunities, right? And as soon as we as the industry start solving those issues, there's going to be more opportunities that's going to be created for everybody. And I feel right now we're kind of in almost like a zombie land where nothing's really happening. But just kind of looking back at the last cycle, there's going to be a point where there's a switch that's turned on and everybody will say it's time to solve issues. And that's when everybody will start being busy. And we don't know what's going to happen with interest rates. We all hope that interest rates will go down. But obviously, we had some inflation data that came in that wasn't very positive recently. I think there's going to be hopefully a point either interest rates go down or the market will say, okay, let's figure out how to move forward. And once that happens, that's when everybody will become very busy.
I fully agree. And I think we're all starting to see some green shoots, as it were, of people who sat around a year or two and they need to make stuff happen. And I think you are one of those guys making things happen. So on behalf of the entire economy, we thank you. And I also just want to thank you for just taking the time to spend some time and chat about your overall archery career, which has been very successful to date. You're a very young guy. Can't wait to follow more and more successes, watch your organization grow, the portfolio grow, and just continue to be an inspiration to people out there who are looking to make deals happen. And David, with that, I guess we'll wrap and just want to thank you again for being here with us.
Thank you so much once again for having me on this podcast.
Awesome. Thank you for joining the Dealmaker's Edge. Don't forget to follow us on your favorite podcast platform. Give us a 5-star rating so more people can follow the conversation.